Hi, Hunter.
Hi.
Looks like just me and you so far.
It's okay.
Where is the rest of our group? Normally we get about 4 people, don't we?
Yeah.
Okay, we'll just wait a minute. This chapter is kind of a dull read anyway. I don't know how much of it will ever be on your test, but we'll go through it. So let's just wait another few moments here.
Okay.
Do you want to show your face, Hunter, or are you hiding?
I'm driving right now.
That's okay. All right, we'll give it another moment here. Yeah, I wonder if it's just going to be you and me, but that's okay. All right, let me share a screen and we'll get started. Okay, we finished chapter 6. Can you see the PowerPoints now?
Yeah.
Let me just make sure I get the right ones up. All right, hold on. Okay, can you see them now still?
Yeah.
With the blue stripe going across horizontally?
No, I'm looking at a blank screen now.
Okay, let me get it set up for you then. Share screen. Okay, now you see it?
Yeah.
Okay. Hi, Miel. How you doing? All right, here we go. Off we go in chapter 7. And I don't think this is going to be a long class. It just takes you through some items about fraud. Tells you how to commit fraud, I guess, huh? Define fraud, internal controls, things like that. Fraud. Fraud is stealing. We know that, right? Fraud is illegal. Fraud is cheating. But most of the people who commit fraud never thought they would be doing that in the first place. I'm going to say most of the people who are caught committing fraud never would have done it except they were given a good opportunity to. And that's what they're talking about with this triangle here. If you're under financial pressure in your personal life, like most of us are, and your company has weak controls, that gives you an opportunity to steal. And it's very easy to rationalize it by saying, well, it's a big company. They're not going to miss these few $100s I'm going to clip. Okay. So fraud occurs when there's financial pressure, opportunity, and the rationalization. Back in the about 20 years ago, 20 plus years ago, there were a spate of highly publicized bankruptcies of corporations due to corporate fraud. Enron was a big example. WorldCom was another one. Bristol Myers. Sarbanes-Oxley Act. What I just like you to know what this law is. This is a law that was created about 20 years ago, and it requires companies to do things you thought they were already doing. It requires them to maintain a system of good internal controls. Internal controls means the systems and policies that protect your assets. The corporate executives and boards of directors must ensure that these controls are reliable, and the independent outside auditors must attest. Sarbanes-Oxley. What are we talking about with internal controls? We want to safeguard assets, enhance accuracy, improve efficiency of operations, and make sure we're doing things legal. Internal control is used in a business to enhance the accuracy and reliability of its accounting records and to safeguard its assets. Internal controls may help you prevent fraud a little bit, but if someone wants to cheat and steal, they will do just that. Okay? Internal control components, control environment, risk assessment, control activities, information and communication, monitoring. Let's go through these a little bit. Establishment of responsibility. One important thing to safeguard your assets is make sure people know what their job is. Who is responsible for what? You're responsible for doing the bank reconciliation. You're responsible for actually handling the cash. And you, the third person, you're responsible for taking the money to the bank. So you establish responsibility among different people so they're clear what their role is. And then the most important thing you could possibly do is segregate duties. Different individuals should be responsible for related activities. Responsibility for record keeping should be separate from physical custody. Like I said just now, you don't want to have the same person open the mail, take the checks out of the envelope, take the money to the bank, do the bank reconciliation, enter everything into your system. If you give a person too many responsibilities around the same general job, that can really lead to fraud. And I'm going to tell you my favorite brief story about a woman from Santa Barbara, got out of high school and got a job at the police department. And she did exemplary work for a number of years. She was there 10, 15, 20 years. And she was such a good employee, they put her in charge of the parking fines. You know, those pesky $40 parking fines you get on Shoreline Drive. Well, she was an honest person until they said, you can control the computer system behind it too. Well, what she quickly learned was that when I got a parking ticket on Shoreline, I sent in my $40, she would delete my record from the ticket database like it never happened and keep the $40. She ended up stealing close to $1 million over a period of years. That's an example where the opportunity and the rationalization, come into play, and the financial pressure. Obviously, you want to have documents that are pre-numbered and everything should be accounted for. Principles of internal control, all kinds of things we can do. We can put in cameras, safes, time clocks, alarms, all kinds of different things, physical controls. Principles of internal control activities. Records periodically verified by an employee who's independent. Once in a while, you'll have a person who doesn't do the bank reconciliation do the bank reconciliation. Or once in a while, you have another person check the bank reconciliation. These are different ways to control your internal control activities. Principles of internal control activities. What the human resource can do is conduct background checks, obviously, rotate employees and require vacations. One of the most, one of the most classic cliched bit of fraud is when the accounting people don't go on vacation. Every company makes the accounting department go on vacation because when you have an accountant who says, oh, I love my job, I don't want to ever take a vacation, that's a very good indication that person has some fraud going and he needs to be there every day to keep the fraud under wraps. And you can bond employees who handle cash. What this means is you hire an employee and you get an insurance company to ensure that they're not crooks. And the insurance company is not going to do that unless they carefully check the person out. So these are different things to do from the human resources standpoint. Principles of internal control. The principles of internal control do not include document procedures, management responsibility. Data analytics and internal controls, different aspects of journal entries can be monitored. Limitations of internal controls. Costs should not exceed benefits. You have a $200 petty cash box that you want to protect. Well, you're not going to hire an armed guard and pay him money to sit there and guard the $200. The cost would be prohibitive. And the human element is always a possible problem in the size of the business. And these are different things we were just talking about a little bit. Which control activity is violated? The person with primary responsibility for reconciling the bank account and doing everything is also the account. That's segregation of duties. Something with the human resources here. In order to keep money on order slips, in order to save money, a local bar does not buy pre-numbered ones. If they're not pre-numbered, that can lead to a real problem because how do you know you've accounted for all of them? Internal controls to cash. Cash is the favorite thing to steal, huh? Who knew that? So again, we establish responsibility. We segregate duties. We have pre-numbered forms that we're going to use to track. Human resources will do their job up front, hiring only capable people. We'll have safes. We'll have all kinds of things. Control of cash. Wow, look at all this, huh? Over-the-counter receipts, segregation of duties. The clerk enters the sales and counts the cash. She then sends it to the cashier. The cashier counts the cash again and fills out the deposit slip. Then it goes to someone else in accounting, and they move it up to somebody who's actually going to enter it. So it looks like you have 5 different people here involved in the process. If just one person was doing all this, it would be very tempting to steal. Mail receipts should be opened by 2 people. A list prepared. I've never heard of that, to be honest with you. Opened by 2 people. Yeah, each check should be endorsed right away for deposit only. Each mail clerk signs the list. Basic things. Question, permitting only designated personnel, such as cashiers, to handle cash receipts is an application of the principle of establishment of responsibility. I was about to say segregation of duty, the establishment of responsibility. Cash disbursement control. You have a petty cash fund, you have some vouchers. Cash disbursements control. Again, you've got documents that are numbered, segregate the duties, establish the responsibilities. The use of pre-numbered checks in dispersing cash is an application of the principle of documentation procedures. I'm not going to talk about a voucher system. That's old-fashioned. El Cortez is concerned about the control over cash in his restaurant. The restaurant has 2 cash registers. At no time do more than 2 employees take orders and enter sales. Work shift range 4 to 8 hours. He wants help installing a good system of internal control. Well, their solution is a separate cash drawer is assigned to each employee at the start of the work shift, with the registered totals set back to 0. Each employee should have only access to their own drawer. They should be given a receipt. The employee should do a cash count, and a separate employee should compare that cash count with the cash register tape. And you can put an automated point of sale system in, like a perpetual QuickBooks type thing. So there's a lot of things you can do to control cash. Control features of a bank account. Use of a bank contributes significantly to good internal control over cash. I'm chuckling because what business does not use a bank? Huh? Electronic funds transfer, we do that all the time. Here's a look at a bank statement. And a bank statement is going to show you the beginning. It's always going to have like a horizontal presentation. It'll show you the beginning balance. It'll have the increases, the decreases, the ending balance, and then it will have in date order all of the individual transactions. And you're going to take this bank statement every month and use it to prepare a bank reconciliation, probably the most important internal control you could possibly have. So we looked at what the bank statement looks like. The control features of a bank account do not include having auditors verify the correctness of the bank balance per books. You can tell I'm moving fairly quickly through this because I want to find some meat here that'll help you guys out for doing your homework and on tests. Reconciling the bank account, super important. The bank balance says that we have $100,000 in the bank at the end of the month. We say that we have 200,000 at the end of the month. Is there a problem there? Probably not. Probably and hopefully the reason we have differences is due to timing. Deposits in transit, outstanding checks are in the mail. A deposit in transit is a check written by one of our customers that is in the mail to the bank. The bank doesn't have it yet, but we have recorded it. Same thing with an outstanding check. That's a check that we wrote and we mailed it to the bank. The bank doesn't have it yet, but we recorded it. And then there could be some bank memoranda we don't know about, some bank notifications. So look at this template here. Here we're going to get into some numbers, I hope. Bank statement. You start with the adjusted, you start with the bank balance per the bank statement. You add the deposits in transit and you subtract outstanding checks. That's all you have to do. That's all you have to do on that side. Bank statement, balance, add deposits in transit, subtract outstanding checks. Don't worry about bank errors. We're not going to give you any problems where the bank makes the error. We're the ones who make the errors. So we've adjusted the bank side. We come to the book side. We take the balance per the checkbook, and we're going to look for anything that the bank did we don't know about. It turns out the bank electronically collected some deposits for it. We did not know it. It's in the bank statement, but it wasn't with us. We have to add that in there. We have a bounced check, a bad check, a non-sufficient funds check. The check bounced. We have to subtract that. We didn't know the check was no good. And the bank charges us for service charges and other things. And we could make errors, not the bank. We make the errors here. That's our job. So on your homework, hopefully they'll give you some bank reconciliations. And hold on one second. I just need to check something here. Here they're giving us some information about a bank statement. They're saying that the bank statement balance is $15,907.45, and the balance per our checkbook is $11,709.45. Here are the reconciling items. There was a deposit that we made on April 30th, but we did not take it to the bank until the next day. In the meantime, we got the bank statements through the end of the 30th. There were outstanding checks that we wrote. 453, 457, 460. Those have not been received at the bank. Then the bank statement showed us that we have unrecorded electronic receipts, 1035. We have to add that to our side. And then we have other charges. The bounce check, one of our customers wrote a check. We deposited it into our bank account. We debited cash. We thought we had the money. And now the bank statement says, no, the check was no good. And then we have bank fees and bank charges. And we also had a company error, Check 443 was written for $12.26, and the bank paid $12.26. We recorded it as $12.62 by mistake. I don't know how you can make that error in a computer system, but let's assume that you can. So that's like $36 we didn't think we had. So here's the process. Here is your template. Template. A picture. When I say template, a drawing. You have the cash balance. You start with the balance for the bank statement and for the books. And here we go. We have an EFT transfer that the bank picked up. We have, I want to see if they go back to the bank reconciliation. You start with that. And now they're showing you the journal entries you need for the bank items. Remember that that electronic funds transfer that the bank picked up for us? We have to debit cash, credit accounts receivable. It was a payment from a customer. The cash disbursements, we had that error where we wrote a check for $12.26, but we recorded it as $12.62. The difference of 36 is to the good in this case, in that we debit cash, credit accounts payable, and NSF check bounced. All you can do with that is put it back into accounts receivable and go after the guy again for payment. And then your bank charges. The reconciling item in a bank reconciliation that would result in an adjusting entry would be the bank service charges, okay? Everything else you see there, the bank already knows about, and the bank doesn't know about, but we do. Let's see. Bank reconciliation. I hope they give us a better example of a reconciliation here, but you have a reconciliation. You have an NSF check. You deduct that from the books. You have an electric funds transfer. That's an addition. Outstanding checks are deducted from the bank. Direct deposits are added to the bank. This will become much clearer, I think, when you start doing your homework, especially those earlier, easier exercises when they introduce you to the actual bank reconciliation. Let's explain the reporting of cash and the basic principles of cash management. We know what cash is, right, Miguel? It consists of money, coins, paper, credit cards, or cash. Listed first in your current assets, cash equivalents. And that's what your cash is going to look like on your balance sheet. You're going to have cash, short-term investments, and then any other cash you might have, short-term. Which of the following statements correctly describes the reporting of cash? Cash is listed first in the current asset section. We kind of know that. I'm not going to go through this in great detail, but when you're looking at your PowerPoints, take a peek here. Cash and cash equivalents are comprised of coins and NSF checks. No, and then NSF checks have nothing to do with it. Restricted cash is an asset, depending on the circumstances. It could be current or non-current. A company may have a negative balance in its bank account. In this case, it should offset this negative cash balance against cash on the balance sheet. No, you can never have a negative balance. If you do end up with a credit balance in cash, that indicates that there might be a problem. It might be there's a transaction that you haven't recorded. There might be a deposit that you have not recorded yet. It might be that you're floating checks, something you're not supposed to do, but everybody does it, where you have no money, but you write a check anyway. You write a check on Friday and you mail it, and you hope that you get the money to cover it in the next couple of days before the check clears. Merchandising operation here. I don't think we need to get into this here. It starts buying inventory, selling inventory, collecting cash, receiving cash. Boy, that's a hard-hitting graphic. Cash management. What are the kinds of things we can do with cash management? Well, certainly we want to speed up the collections procedures. We want to collect our money as quickly as possible. So there's certain ways to work on that. Keep inventory low. You want your inventory to be as low as possible with still having enough to meet your current orders. It's easy to meet all your orders if you put a big ton of inventory away, but that's a real waste of money, a real waste of resources. And you're going to end up paying for it in other ways with damages and theft and shrinkage and losses. And you plan the big spending. And if you have extra cash, invest it wisely. Cash budgeting shows cash flows usually over a couple-year period. It's going to be broken out into cash receipts, cash disbursements, a financing activity, and other spending, which are not showing up here. Now, when you get to accounting 240, you're going to be doing a big one like this. But I'm just going to take you through it quickly. We have a budget here. At the beginning of the year, our balance was $38,000. We had collections from customers and sales of securities. We had total receipts thus of $170. That gives us $208,000 of available cash. We're going to spend so much on inventory, salaries, selling expenses, and income taxes. Total disbursements are $182,500. We have an excess of $25,000, okay? So we're good. We just take that $25,000, it becomes the beginning balance next year. Now we go through the same process. This time we have available 233, but our spending is a lot more, and we now have a deficit, a deficiency, because they don't tell us this here, but they wanted us to always have 15,000. So we have to borrow 3. Anyway, this is an example of a cash budget, very common. All companies do something like this. And again, I'm always saying I used to like to do things. I used to like doing the budgets. That was my favorite chore. At Thomas and Betts, where I worked, it was about a 2-month process. We began right around this time of the year, around Halloween. And by the Christmas break, that budget was locked into stone. Not locked into stone, it was set in stone. Martians company's management, they're out of this world, this company. They want to maintain a minimum monthly balance of 15. At the beginning of March, the cash balance is 16.5. Cash receipts were 210, cash disbursement 220. How much cash, if any, must they borrow to maintain the desired balance? Well, let's see. They started off with 16.5, and it looks like they're going to knock that down to 11.5. Huh? They're bringing in 210, but spending 220. So they're going to have to borrow an amount between 11.5 and 15,000 to get them up to 15,000. And since you often have to borrow in increments of 1,000, they might have to borrow an extra 500 on top of that. Let's talk a little bit about a petty cash fund. My goodness. Petty cash fund, it's a box on a desk. It's a box in a drawer that one of the people in the office maintain. It's going to have a couple $100 worth of coins and dollar bills, nothing big. And it's used for tiny, tiny little nits and picks that come up during the day. The UPS guy shows up with an envelope. He says, you owe him $1. Are you going to tell that guy, come back next week when we run checks? No, you're just going to hand him a buck out of petty cash. And when you do that, you're going to hand him a piece of paper, a little chit. He's going to sign that he got the $1. You give him the $1 and you substitute the handwritten receipt. At all times, the receipts and cash must equal $200, whatever your petty cash fund is. When you set the fund up, you're setting up a new bank account, a new account. You debit petty cash and you credit cash. You've set up a new account, okay? The custodian has the authority to make the payments, and the size of the payments are limited. You want the petty cash box to last 1 month, roughly. If you're constantly filling the petty cash box every week, that's no good. It means you need a bigger box, or you're more likely you're paying bills that are too big. Someone comes to you from a company dinner and they hand you a receipt for $55. Well, $55 is a lot of money in a petty cash transaction. So that person's going to have to wait for their money. You're not going to pay them right out of petty cash. Now the end of the month comes. You in petty cash, you've been getting these receipts, and you've been filling in a report in Excel probably, where you drop the money in and where it was spent. Now, the petty cash requests a check for $87. How come? Because they spent $87. There's only $13 left in the box. So you debit postage expense, which they're telling you, freight out, and miscellaneous expenses. Here, they only had $12 in the box, which means they lost $1. So you have the same expenses plus a fourth one called cash over and short. And then you could also go cash over, and you'd have a credit balance there. Compare the accounting. You know, we don't go into this. We don't go into the international financial, whatever that is. So this chapter, I must admit, is a bit on the dull side. The most interesting part to me is the bank reconciliation itself. And I can't emphasize how important that is as an internal control. Because once you've reconciled your bank account, you can take a sigh of relief that every penny is properly accounted for. If you do the bank reconciliation and you find out that you have a balance in your books of 100,000 and the bank has a balance of $2 after you reconcile, that's a problem. Somebody stole money. There's something terribly wrong there. Okay. So do what you can with this chapter. It's like I said, it's not a big one. I don't know if it'll be a big hitter on your test. I would hope not. So you okay, Miguel, then? He must be okay. How you doing, Hunter?
I'm doing good.
Okay, so that was kind of a dull chapter, wasn't it?
Yeah.
You hesitated. Okay. Well, I guess we'll let us go then. Okay, Hunter?
Okay.
Off we
Thank
go.
you.
We'll see you later. Bye-bye. Bye-bye, Miguel.